Good morning. And in today's session, we are going to discuss about the let out house and the types involved while letting out the house. So there are the various types of problems are there in this let out house. If you look at uh, generally, we let out the house, say in the previous year or called as financial year, and during that whole year, you have received a rent and the house was not vacant. This uh, could be one situation. Am I right?
Yes,
Yes. Yes, guys. Yes or no?
yes, sir.
Yeah. And there might be second situation where you have given a let out house for the complete year and there was no vacant, but the rent has not been realized. Means he has not paid the rent. He for 1 month he didn't pay. He went away. Though out of 12 months, only 11 months he paid. 1 month he didn't pay. So that is called as an unrealized rent. There could be this kind of situation also. And the third situation where you have let out the house was vacant for some period during the previous year, but there was no unrealized rent. That means there was no any bad debts. In simple to understand, I'm telling that unrealized rent is like a bad debt. That fellow, he stayed in our house, but he didn't pay the how he didn't pay the rent. He went away. We couldn't trace him, and it is very difficult to collect that rent. That is called as an unrealized rent. So in the second situation, there was no vacant, but there was unrealized rent. In the third situation, house is vacant for some period, maybe for 1 month or 2 months out of 12 months, 10 months, we have let out the house. 2 months was vacant, but there was no unrealized rent. Okay, this is the third situation. Then fourth situation is where the house has been let out and in a previous year, in that there was 2 months vacant and 1 month unrealized rent out of 12 months. So only 9 months you have received, but whereas the 2 months was vacant and 1 month for unrealized rent. That means that fellow for 1 month he didn't pay and he went away, or we couldn't able to collect from him. That is the fourth situation. So that means the fourth situation is a mix of the first three, or the first three situation. Okay. So if we do this fourth sum or one sum, that will be able to cover the first three. But first we will do the one by one steps. And there might be one situation where, as we have seen, the coronavirus effect, where the house was vacant for 12 months, especially in the outskirts areas. There was no one to take the rent. So that might be also be the situation. So you want to let out, but the house was vacant for complete year. And situation six, the house is situated in metro cities, how to calculate. And if the house property is situated in foreign country, then how to calculate the income from house property. So these are the seven situations when you are letting out your house. Among that, these fourth sum will come mostly for exam. This fourth variety or the fourth situation is very, very important one. Hence, I am trying to put a kind of a star mark for you to think that this situation is this is very, very important. So in the exam, most probably you get the fourth situation type of sum only, where the house has been given out let out for in a previous year. Out of that, there might be 8 months, 9 months, 6 months you might have been received rent. For 2 months there might be unrealized rent. For 2 months there might be vacant. So which covers the first three situations in the fourth situation. Hence, and maximum sums has been given in the exam also, this fourth kind of situation. So you have to focus on the more on this fourth varieties of problem. But however, if you want to go to that fourth situation type of problem, you have to learn the first, second, third also, so to understand that. Okay. And now coming to the how to solve the problem. there are three steps involved in solving the problem when you are calculating from income from house property. For step one, first you have to calculate the GAV using the three steps you in the working notes. First, you should do the working notes. Okay, so in the working notes, the you have to calculate the GAV. How to calculate the GAV? In the yesterday's class, I have explained. However, again, I am going to explain here in today before starting the actual entering or solving the problem. Then step two is you have to prepare the statement, the computation statement yesterday, which has been shown to you. Again, for your benefit, again, I am going to show this. And third, step three, you have to allow the deductions under section 24 here, and wherever the working notes is required, the most of the problem is going to do or is going to be solved in the working notes only. The lot of the calculations are going to do it. So this is how you are going to calculate the income from house property when you have been let out your house for let out house for rent. Okay, so this is the one situation. Now, as I said, how to calculate the GAV, gross annual value. So this has, as I already told, first you have to do it in the working notes. So particulars amount, this is a column that you have to do. Step one, you should take municipal rental value and fair rental value. You should compare these two. Among these, whichever is higher, you have to take it on the higher side. That we call it as expected rental value. Guys, is it clear? Yes, is it clear? The first step one, you should take municipal rental value or fair rental value. In the sum, you will give these two values. You should take these two values and you should compare, and whichever is higher, you have to call it as expected rental value. After step two, then you are going to calculate the adjusted ERV, adjusted expected rental value. So whatever you got in the step one, that you are going to take here ERV, and standard rent will be might be given in the problem if that area is coming under the Rent Control Act, where the rent controller is going to fix the rent. If that is there, then you have to compare these two, and among these, always your ERV or standard rental value, whichever is less, that should be taken, and that will be called as adjusted ERV. Then this adjusted ERV is going to be taken in the step three as the first one, and what actually for what value you have given it on a rent, that you have to calculate and you have to put it. Now you have to compare these two, and among that, whichever is higher, that you have to take it as a uh, um, actual rent, the actual rental value or gross annual value, what we call before. Suppose if any unrealized rent is there, unrealized rent means where he didn't pay, he went away, and then you have to deduct from this whatever the value you got here from the actual rental. From the actual rental value, always you have to minus any unrealized rent. If anything is there, if any common facilities has been provided, that value should be deducted. Then what you get, you call as gross annual value before vacancy period. If the house is being vacant, if the house is not vacant, that itself is a gross annual. Suppose if the house is vacant for any 1 month or 2 months, then deduct that value, then you call as the gross annual value. So this is the process or steps involved in calculating the gross annual value. Step one, all these you are going to do it in the working notes. Okay, then we have step two, computation of income from house property. So there, this is, you are going to begin with this in the problem. First, you have to keep heading the computation of OJA's income from house property for the assessment year 2021. Then you have to draw these two lines, two columns. One is column for particulars, one column for amount in rupees. then here first you are going to take the GAV, which you have calculated just now in the working notes. From that, you should deduct the municipal tax if paid by the assessee. Okay, suppose if the municipal tax is 20,000, he paid only 10,000, another 10,000 he didn't paid, he is going to pay in the next year, or if he says, but whatever the municipal taxes paid only we are going to deduct, but not what he has not paid. Okay, then when you deduct the municipal taxes, you get what we get is called as NAV. Okay, and from the NAV we are going to do the deductions under section 24. Under section 24A, standard deduction 30% of NAV. So suppose here NAV is, suppose let us assume here 1,20,000 gross annual value, municipal tax is 20,000, and here you got as NAV as 1 lakh. And that means 1,20,000 minus 20,000 municipal tax. So you got 1 lakh as NAV. On 1 lakh, you are going to calculate 30% NAV. So you will get here 30,000. Okay, and if suppose if a assessee has borrowed any interest on capital from any banks, or for the previous year, if any interest he has to pay, that you can take, and that is eligible for deductions. And if any pre-construction interest is there, that also is eligible for deductions. We'll add these both two and deduct standard deduction and this deduction. Let us assume standard deduction 30,000 and 10,000 is both previous interest and pre-construction interest 10,000. So 30 plus 10, 40. So from 1 lakh minus 40, 60,000 will be your taxable income from house property. This is how you have to calculate for the income from house property. Okay, so guys, take the book and we will start draw the two columns. We are going to do one sum quickly to understand the sum. Okay, and we already I shared with you in your WhatsApp group regarding the sum that which I am going to calculate, which I am going to do it today. Did you see that? That
Yes,
is
sir.
problems from income from house property. Okay,
Yes, sir.
so if you look at the problem, or those who have access to that, you can go through that problem. However, I am going to share the screen where you can know, or you can also see that here, those who have an access, you can open it. So here the first problem is saying that on 1st April 2019, Mr. Jagdish is the owner of the house, which is he let out to Sri Mohan Lal on a monthly rent of 6,800 and received 3 months advance rent to 12,000 as caution deposit or security deposit. The municipal rental value is 60,000 per annum. Rent of similar building is 8,000 per month. What do you mean by this rent of similar building? This is a new term I'm finding. What does it mean? Which is called as fair rental value. Rent of similar building is called as the fair rental value. And the Jagdish has incurred certain following expenses: municipal taxes 6,000, insurance 300, interest on loan taken, ground rent, repairs, collection. Compute the income from house property. So this is how he has asked us to uh, this is what he has given as a sum for us. So first, what we have to do, guys? Um, yeah, anyone remember? First, what we have to do?
Calculate the GAV.
Calculate the
GAV.
GAV. Now, how to calculate the GAV? First thing, you can either you draw you the step one. We have to compute. You have to everything you have to do in the working notes. Okay. So working notes here. Here the first calculation of GAV. that is gross annual value. Okay, GAV means gross annual value. Okay, which we also called as GAV. Right. Now, this when you are calculating the gross annual value, did you remember the format just now? How we have did this? Yeah. What we have to do first? What you have to
minus this
Where
municipal or one thing which is the lesser
step one? You have to calculate
municipal
calculation of
notional rent.
notional or expected rental value. Okay. And when you are calculating the expected rental value, you have calculation of expected rental value from the following whichever is higher or lower,
Higher.
whichever is higher, right? So whichever is higher, right? Now here in this problem, so what we have to take first, municipal rental value, correct? Municipal rental value, which we call as MRV. MRV, how much he gave in the sum? Municipal rental value 60,000 per annum.
Yes.
60,000 per annum. So when you are taking a per annum, always you should take per annum only. Okay. Or what is the next one? You should take the fair rental value. What is called as a fair rental value? The rent in a similar building in same locality. What he has given as 8,000 per month, correct? So 8,000 per month, 8 into 12, that is going to become 96,000. Am I right?
Yes.
So when you compare these two things, or whichever is higher, so what now how much is going to be the expected rental value? Whichever is higher means 96,000 is the higher one, right?
Yes.
Now this is the what you are going to do when you are calculating the gross annual value as step one. Then step two is you have to again you have to compare or calculation of adjusted ERV. Okay, calculation of adjusted ERV from the following. Is it whichever is higher or lower?
Lower.
Whichever is lower. Okay, whichever is lower. Now here we have first two thing what you have to take. You have to take ERV, which we have calculated. Is it clear? First step one in step A, what we have done, that you should take care as ERV. Okay. ERV. How much is the ERV in the somewhat in which we have calculated just now? 96,000 rupees. Yes, guys.
Yes, sir.
So 96,000 rupees. Or what is the next one? if it is a standard rent is there, that standard rent you have to take. If the standard rent or standard rent is that information is been given in the standard rent information has been given here in the problem? No, right? Yes, any information has been given?
No, sir.
No. So here, whichever is lower means 96,000, standard rent, no information. No information means, so you cannot take it as a zero. Okay. Yes, guys, are you with me?
Yes, sir.
You cannot take it as a zero. So we are going to take this the same value because the value cannot become zero. So we are going to take this 96,000 rupees as the adjusted ERV. Okay. Then we have C bit or the C where you are going to now calculate the GAV, calculation of GAV, okay, gross annual value. Here, what are we going to do is, again, calculation of GAV, calculation of GAV from the following whichever is higher, okay, whichever is higher. So what are we going to now? First one, what we calculated in the step 2, that is AERV, adjusted ERV, is equal to adjusted ERV. Adjusted ERV we got is 96,000. Am I right? And or now we have actual rent value, actual rent, actual rental value, which we call as ARV. Actual rental value is equal to for how much they have given on a rent, on monthly rent of 6,800. 6,800 into 12. Guys, can you quickly do it and tell me 6,800 into 12, whatever the value, that is going to become the actual rental value. Okay.
81,600.
How much?
81,600.
Rupees 81,600. Now, what are we saying here? Whichever is higher. So now which one is higher now? Obviously AERV 96,000.
Yes.
Yes. Therefore, GAV is equal to rupees 96,000. Is it clear, guys? How to, did you understood how to calculate the GAV? Yes,
Yes, sir.
guys. This is the how you are going to calculate the GAV. After calculating the GAV, then you have lot of things where you are going to do is, now this, let us assume this is working notes 1. Okay, working notes 1 is calculation of GAV. We are going to do the some other working notes also are there, hence we leave some space for this. And second step, first you have to keep heading computation of what is the name of a person of whom we are doing computation of, is it Jagdish?
Yes, sir.
Jagdish income from house property for the which year? For the assessment year 2020 2021. Am I right?
Yes, sir.
And After that, you have to draw the two columns. I already said those who have textbook, those who have notes in front of you, you can draw these two columns. Okay, and this is a heading. What are we going to write here? And particulars, first column, and the second column is for amount. Okay, amount in rupees. Now, starting with the gross annual value. Gross annual value. Did you remember, guys, the format? Gross annual value. After the, what is the next one? What you have to do from this? Anyone remember?
Less municipal tax.
Yeah,
Is during
less
the previous.
municipal tax. Yesterday's one, what which has been sent. This is less municipal tax. When you deduct the municipal tax, what you get? What we call it as
Net annual value.
net annual value. Am I right? And from the net annual value, we will do the deductions under section 24, correct? And under section 24, A, we have standard standard deduction where that is 30% of NAV. Am I right? And B, interest on loan. Okay, then what we get, we call as the income from house property. This is the one what you have to draw, or this is how you have to draw in your book. And now we have to start competing. Okay, so the how much we got here, gross annual value just now, 96,000. Yes, guys.
Sir.
Gross annual value is 96,000.
Sir.
Gross annual value is 96,000. Now, how much is the municipal taxes? Can you quickly tell me? Municipal taxes?
6,000.
Sorry?
6,000.
6,000 rupees. Okay. So municipal taxes are 6,000 rupees. So that we are going to minus it. Am I right?
Yes, sir.
So minus 6,000. Then after when we minus, then what we get, we call as the net annual value. How much are we going to get? 90,000. Am I right?
Yes, sir.
And so net annual value, what we got is 90,000 rupees. Now, what is the standard deductions that we should give? 30% of NAV. 30% of NAV means what are we going to get? That is on 90,000 into 30%. When we calculate, how much are we getting the amount?
27,000.
27,000, correct? So here only you can write 27,000 rupees. Okay, and interest on loan, any interest on loan is there, guys, in the sum? Is assessee is paying, Jagdish is paying any interest on loan?
Yes, sir.
How
13,000.
much?
13,000.
13,000. So 13,000. So these are the two deductions are allowed which can be deducted from net annual value. Am I right? Okay, so now we have to add these two deductions, 27,000 plus 13,000. That comes the 40,000 rupees as deductions. Okay, 40,000 as deductions which can be deducted from 90,000 rupees. Okay, so when we deduct now 40,000 from 90,000, then what we get is 50,000 rupees is income from house property. Okay, guys, is it clear? Uh, this is what? Okay, now actually, what you have to do, these working notes too, standard deduction also, you have to do it in the working notes. Here, there, I've shown you to understand very clearly. So your working notes too, you whatever the calculations you did, you have to do it in the working notes only here. Okay, so second one, calculation of guys, just take the screenshot of your attendance sheet and send me in the WhatsApp. Calculation of the standard deduction under section 24A. Here, net annual value. The net annual, what is the net annual value? Is it 90,000? Yes, guys, is it 90,000?
Yes, sir.
So standard deduction is equal to NAV into 30%. Okay, so that is equal to 90,000 into 30 divided by 100, which is equal to 27,000 rupees. 27,000 rupees. Have we did any other calculations here? We didn't do any other calculations because everything what he gave was it was there that interest on capital was directly what has been given, that we have been taken in computation of income from house property. Okay, so only those are the two calculations we did, hence that we are showing in the working notes. If you want here, you can also write how did you arrive at gross annual value. So here, if you want, you can write to working notes 1. Okay, so they can also look at that you have done at uh, working notes. Okay, you can show it as working notes 1, and here this also, here if you would have not done here, you can also show as the working notes 2. Okay, this is how you are going to show or calculate the sum. Any doubts, guys, before winding up the session, as the time is also up? I hope you understood, and I gave one sum as an homework. So please, guys, take the sum which I have given it as a homework for you. And if you have any doubts, you can contact me.